It's a pleasure to be here, even though I have to be here electronically, but still I think that the conveners of the conference have done an excellent job to make sure that we can have the communication anyway. So with that, let's begin the first slide if we can. And so I call this presentation After the Gold Rush, a perspective on future U.S. natural gas supply and price. And I call it After the Gold Rush because I think that what has occurred in the last 5 or 6 years here is very similar to a gold rush, where everybody rushes in, thinks they're all going to make a lot of money, and then when it's over, very few people actually have, and simply we've displaced a lot of workers to a new location. Next slide, please. And so there is a phenomenon in shale gas which I call magical thinking. Magical thinking, of course, means thinking the way you want things to be, as if by magic, and not reality. And so I begin with this quote from the ancient Tao Te Ching, which basically means if something sounds too good to be true, it probably is. And that's the way I think that it is with shale gas and its economics. Next, please. My view, my conclusions are, it is doubtful that shale gas will fully meet the expectations for supply in North America, except at much higher natural gas prices. Next. The shale gas gold rush is ending. The oversupply of gas that we currently have in North America will result in financial distress this year in 2012. For some of the heavily natural gas-weighted companies. Next. The companies have gone to more liquid-directed drilling. This is a good thing. This will decrease gas supply over time because the more liquid-prone plays have less gas associated with them than the dry gas plays. Next. The biggest problem with shale gas production is that the decline rates are very, very high. They are much higher than anybody expected, and I'll show you data that supports that. Next. Non-shale production, in other words, conventional production, is declining. In the United States, 70% of our current supply comes from non-shale production. No one's spending any money investing in these projects, and so eventually the decline of the 70% will overtake the production increase, which is actually now flat from shale gas. Next. On top of that, demand for natural gas in the U.S. is increasing. Next. So we take all those factors, put them together, and it looks like we will probably see the end of the natural gas oversupply sometime in the next year or two. So this slide shows what I call the resource pyramid. The resource pyramid is a very simple concept that I think most people in ASPO are familiar with. What it means is that at the top of the pyramid, we produce the resources that are very easy to find, that don't cost very much and are high quality. And let me just summarize this slide saying that there's no way that shale reservoirs will perform as well as conventional reservoirs. The economics of shale gas require high prices, and when I say high prices, I'm talking about perhaps $7 per 1,000 cubic feet, because that's the cost of production. Basically, what we have to understand, and this is consistent with Werner's comments, that once you start drilling shale wells, you can never stop. This is not a process where you spend a lot of money in the beginning and then sit back and watch the profits come in. So let's go to slide number, and so finally, my comment is that shale plays are not a renaissance or a revolution. This is a retirement party. That's what we're talking about. We're looking at the bottom of the resource pyramid. This is the last thing that's left other than gas hydrates. So for people who champion shale plays as being a a revolution or a renaissance, they're missing that they're almost being kicked out the door. Let's go to slide number 4. This graph shows the U.S. Price of natural gas since 2005. Basically, what this shows is that the United States gas industry has been in a process of self-destruction. They've been consciously overproducing gas, knowing that it would undermine the product price. Why have they done this? There are many reasons. The common reason is they've done it to hold leases by production, or perhaps they're adding value to their leases and they think maybe they can sell their company or the land to some foreign company that wants to be involved in the play. Next, please. They don't talk about this, but in fact, there are many commitments that these companies make to drilling rigs. They promise pipelines a certain volume. They're penalized if they don't provide that volume. They have partners that they're contractually obligated to perform with. They have variable production payments, which is a form of selling forward your gas in return for a cash payment today. And then, of course, they have joint venture agreements with companies like Statoil and the Chinese National Oil Company, Total, etc. And these all have contracts that require them to keep drilling gas even though the price is not there. Next, please. Probably the main reason is that these companies want to preserve their stock price. They don't have any cash. They don't have any earnings. So the only thing that supports their stock price is their production growth and the reserve growth. And if these two things or one of these two things stop, then people sell their stock. The value of the company goes down. This triggers all kinds of margin calls, loan covenants, etc., and that results in a death spiral. Next, please. I think there's also a growing recognition among certainly the big oil companies, the international oil and gas companies, that there are simply fewer and fewer scalable, large opportunities in the world where they can add reserves. So they're coming to North America because they have to replace reserves. I think also that the larger companies, the international companies, have a business model that assumes that natural gas prices will be much higher in the future. When in the future, we don't know, they don't know. But they're just looking at the numbers, and as resources become scarcer, certainly natural gas will become an increasingly important commodity, and the price will have to rise over time. Now, we've heard a lot of discussion in the United States about the problems of Chesapeake Energy and its chief executive officer, Aubrey McClendon, shown on the right. I don't really want to comment about the internal problems of Chesapeake Energy. Simply, the message of all of these problems and scandals is that this man owns 2.5% of all the wells that Chesapeake drills. He's lost over $1 billion on those wells. Imagine what the losses of the company are that have 97.5% of those wells. They're in probably in the tens of billions of dollars, or at least the billions of dollars. And since Chesapeake is the leading company in the shale plays, the shale gas plays particularly, they have generally the best position. If Chesapeake Energy is losing billions of dollars on shale gas, then probably most of the other operators are. So this is the point. Shale gas is a commercial failure in the United States, at least so far. Next slide. I'm going to talk about a few of the specific shale plays, and I want you to understand where they are on a map. The Eagle Ford Shale is the lowest on the map. That's in southern Texas. The Barnett Shale is directly above it. This is the oldest shale gas production, commercial shale gas production, probably in the world. It's in north central Texas. To the right is the Haynesville Shale, which is in Louisiana and eastern Texas. And finally, the Fayetteville Shale is in north central Arkansas, just to the northeast of the Haynesville. Next slide, please. This is a graph that shows all of the production of the various shale gas plays and some of the gas associated with the more liquid-prone plays, the Niobrara, the Granite Wash, the Bakken, the Eagle Ford. And as you can see, the largest wedge is the blue one at the bottom. That's the Haynesville Shale. The Haynesville Shale currently represents more than 11% of total U.S. gas production. Next, please. The Barnett, which is directly above it in light red. The Barnett represents 9% of U.S. gas production. Next, please. The Fayetteville Shale, which is directly above it and in light green, accounts for 4% of U.S. production. The liquid-prone plays contribute to supply but are less significant. If we take all of them together, they account for about 11 or 12% of U.S. supply. Next, please. So I mentioned that really since 2009, the shale companies have been shifting their emphasis from dry gas to more liquid-prone plays. And when I say liquid-prone, I mean condensate, and I also mean the natural gas liquids, butane, propane, etc., that are processed out of the natural gas at a plant. They don't come out at the wellhead. This graph shows in red the proportion of gas-directed rigs, drilling rigs in the U.S., and in green the proportion of oil-directed drilling rigs, and the dashed black line is the ratio of the two. And so after the price collapse in mid-2008, once drilling recovered, it was very strongly dry gas oriented once again. Everyone thought the price would come back quickly because the rig count had dropped so much. Next, please. The increase in liquid-prone drilling has really been the more prominent trend since 2010, with the late adopting companies joining the herd pretty much in 2011. Currently, the percentage of oil to gas-directed drilling rigs in the United States is nearly 250%, from a beginning point of 21% just after the price collapse in mid-2008. So the tendency is strong, and this will eventually deplete the oversupply of gas we have. Why? Well, it's very simple. A Haynesville Shale well, which, as I said, is responsible for most of the oversupply. The average Haynesville Shale well has an initial rate of more than 8 million cubic feet of gas per day. Most of the rigs from the Haynesville have moved to the Eagle Ford, which is a liquid-prone play. Next, please. The average Eagle Ford well has an initial gas rate of only 2 million cubic feet per day, which is a lot of gas, but it's 1/4 of what you get from an average Haynesville well. So this is the order of decrease in supply that we're seeing. The Bakken natural gas is insignificant. All of that is being flared, unfortunately. My point is that this shift is significant from dry gas to liquid-prone plays, but it will take time before this makes a difference. Next, please. This graph shows Haynesville Shale production in red in billions of cubic feet of gas per day on the left-hand y-axis. The dashed blue line is the number of producing wells, which are referenced on the right y-axis. The current production appears to be starting to decline despite the addition of more and more wells. This is really too early to call a decline, but it looks like it's at least stabilized, if not flattening. Next, please. There are currently 60 rigs drilling in the Haynesville Shale. This is down from a high of 220 in late 2009. Next, please. 742 new producing wells were added in the last 12 months. Next, please. Why reserves are overstated. This is a very important point. The reserves of all these plays are overstated, we believe, by approximately 100%. So the true reserves are perhaps half what the operators represent. This graph shows the decline in the base annual production of the Haynesville Shale. And so what we do here, if you look at the dashed blue line, which is the number of drilling rigs, we simply stop adding new wells 12 months prior to the last data point, and then we watch how the almost 1,600 wells that are online decline. And what we see is that in the Haynesville, the annual decline rate is 48%. This is huge compared to a conventional gas well of perhaps 20% per year. Next, please. ITG, which is an independent research group in Calgary, has estimated that the decline rate is slightly higher. They come up with 53%, and they see that the annual replacement volume in the Haynesville is 3.8 BCF per day per year of gas. Next, please. Our work indicates 48% and about 3.4 BCF per day per year of production replacement. To do that, will require drilling 975 new wells in the coming year at a cost of nearly $10 billion US dollars. Next, please. This shows then on the left the amount of wells and the total cost in the Haynesville Shale to produce 3.5 BCF per day for the first time. It required 800 wells at a cost of $2.3 billion per BCF a day. The bar on the right shows what it will cost in rigs and in dollars to replace the current production, $3.6 billion per billion cubic feet of gas per day at a total cost of $13 billion, 1,250 wells. So what we see is that the cost to maintain supply, that's all we're showing, is astronomical, $13 billion for one shale gas basin. And despite operator claims that they keep increasing efficiency, what this clearly shows is that it's taking more and more wells to replace the same gas volume every year. So perhaps they're drilling them faster, maybe they're even drilling them cheaper, but the efficiency factor is simply not there when we examine the data. Next slide. Next, we look at the Barnett Shale production, which is the second largest in the United States. Again, the same scheme. The red is gas volume in billions of cubic feet per day. The dashed blue is the number of producing wells. What we see is that production is currently flat. Whether it will increase or decrease, we don't know. But it's flat despite the fact that new wells are being added, albeit at a lower rate. Next, please. 9% of supply. Next, please. There are currently 50 rigs drilling in the Barnett Shale, down from a high of 185. So it's only logical that production should decrease. Over 1,250 new producing wells were added in the last 12 months. Next and next. And so again, we do the same kind of base decline calculation for the Barnett Shale by stopping to add the new wells for the last 12 months. What we find in the case of the Barnett is that its decline rate is lower than the Haynesville, but still very high. 29% annual base decline rate for the Barnett Shale. Next. That means that we must replace 1.6 BCF, billion cubic feet of gas, per day per year to simply maintain supply flat. That will require 5,739 wells at a cost of $17 billion. Next, please. Devon Energy, the largest operator in the Barnett, they currently operate more than 4,000 wells, recently announced that it will drill no dry gas wells in the Barnett Shale in 2012. So what do we expect for production of gas in the Barnett Shale? It will decrease. Next, please. This bar graph, again, shows the historical number of wells and costs to add 1.5 BCF per day. And what we see is that it, again, just like in the case of the Haynesville, it takes more and more wells to add each increment of 1.5 BCF. So we go from, first we had 4,085. That was still in the time of both vertical and horizontal drilling. The second bar is once we had all horizontal drilling. That was in 2007. The efficiency did increase. It only took 2,234 wells to replace 1.5 BCF. The third graph, we were losing efficiency. It now took 3,700 wells to add another 1.5 BCF. For 2012, the bar on the right, the replacement is 1.6 BCF, and that's going to take something like 5,739 wells at a cost of more than $17 billion just to maintain production flat. Next, please. Conclusion, the field is probably showing signs of depletion. This is just like any other oil or gas field in the world, as you have to drill more wells to produce less, so decreasing efficiency. Next, please. I said in the beginning that shale gas is a commercial failure in the United States. No one but perhaps me is willing to say that, but it's very clear from all of our work with individual well declines and very carefully computed group declines, vintage by year of first production and operator, that this is the case. And if we look at the table on the bottom, these are the break-even prices. This is the marginal cost of production for the Barnett, the Fayetteville, and the Haynesville Shale. In each case, on the left are the full-cycle economics, all-in cost. On the right are the point-forward economics that exclude land costs, these are basically just development costs. And what we see is that even on a point-forward basis, it still takes $5 per 1,000 cubic feet to meet expenses, and that's in the case of the Fayetteville Shale. So none of these plays are commercial at present price, and in fact, none will be fully commercial until gas prices recover to at least $5 or $6. Next, please. This graph is done by Peter Tertzakian with ARC Financial Research in Calgary, and what he's showing here is that the annual decline rate in 2001 for U.S. gas wells was 23%. In 2011, it had increased to 32%. Why? Because we're drilling more and more shale wells that have higher decline rates. Next, please. In 2001, we only had to replace 12 billion cubic feet of gas per day in the United States to offset consumption of 54 BCF per day. Next. Now, we need to replace 22 billion cubic feet of gas per day to offset 65 billion cubic feet of consumption. So as our consumption has increased and the decline rates have increased, we have to replace more gas. So now we have to replace 22 BCF per day compared to 12 in 2001. Next slide. When we look at, or when Peter looked at the 34 major producers that were publicly traded in the United States, he computed that the replacement cost for that gas volume was $22 billion per quarter. Next, please. When he looked at the cash flow for all of those companies, their cash flow was only $10 billion per quarter. That means that for every quarter, there's a $10 billion cash flow deficit to keep supply flat. That means that in order to keep supply flat, producing companies need to accumulate $40 billion of debt every year. Next, please. This graph shows capital expenditure to cash flow ratios for all of the major companies that Bernstein Research follows. You don't need to pay attention to very much of the graph. If you simply look at the right-hand slide, the right column, that's CapEx to cash flow, capital expenditure to cash flow. What we see is that most of these companies are spending approximately double what they're making. Some of them are spending 3 times, 4 times, 5 times. And I've highlighted just some of the major operators in the play. You can see at the top, Quicksilver, they're spending 3 times capital expenditure to cash flow. Chesapeake is almost 2 times. So clearly, this level of capital expenditure is unsustainable and eventually will limit the ability to deliver supply. And then we have acceleration of service costs that will compound this limitation. Next and next. Next slide. Okay, let's look at U.S. natural gas supply. This graph shows where all the U.S. gas supply comes from. The second bar is other states. So if we simply focus on the graphs that represent Texas, Louisiana, Wyoming, Oklahoma, the offshore Gulf of Mexico, and New Mexico, 70% of U.S. gas supply comes from these 5 states and the offshore Gulf of Mexico. Next, please. And so these jurisdictions provide an excellent and easy proxy for supply trends in the United States. Next, please. And so what we're seeing here then are two representations of U.S. supply. The red is what the Department of Energy, the Information Administration says we're producing. The blue is what the individual states that comprise those jurisdictions and the Gulf of Mexico say. Again, the dashed black line is the number of producing wells. So what we see in both of these cases is that U.S. production has become essentially flat by both representations. The disturbing thing, however, is the discrepancy between what the federal government thinks we're producing and the individual states that are producing the gas think they're producing. This discrepancy is roughly 10 billion cubic feet of gas per day, which is tremendous. This discrepancy has not been resolved. Personally, I believe the states, because it's in their best interest to report accurately since they collect tax and royalties based on production volumes. But next, please. Whatever the problem is, if it became known that in fact the lower production number is correct, the price of natural gas would probably increase by at least $1 tomorrow. So this is there's kind of an uncertainty factor here. Next slide, please. The demand side of the equation for January, February of 2012, U.S. consumption increased approximately 5 billion cubic feet of gas per day compared to 2011. The graph on the left shows in blue coal production and in red gas production. On the left is 2011, on the right is 2012. What we see is that gas consumption in the U.S. has increased more than 30%, which is the 5 BCF of gas per day, at the expense of coal. Coal production consumption has decreased by 21.5%. Next slide. So most of the increase in natural gas consumption in the United States has come from fuel switching from coal to natural gas, mostly for electric power generation. Next, please. This will change if gas prices increase. And the graph on the left then shows two curves. The red curve is the price of natural gas, and the blue curve is the U.S. consumption in billions of cubic feet a day. And so what we see is that as the gas price has dropped, consumption has increased. And the critical price point is really at about $3.25 when gas production increases substantially. And so now that gas prices are rising again, we would expect to see switching back to coal, which will then decrease demand and increase supply. By the way, our Environmental Protection Agency is regulating about 20% of coal power out of existence by 2020, which will again increase demand. Next, please. Everyone knows that or at least everyone in North America knows that our winter of 2012 was the fourth warmest in history, or in recorded history, and that's part of the reason that we have so much natural gas surplus. The hope is that we'll have a very hot summer and we'll use a lot of the natural gas oversupply for cooling. This is a prediction map by a friend of mine who runs a meteorological company, and based on his predictions, we will not have an excessively hot summer, so the supply overhang will continue. However, our federal government predicts a hotter than average summer, and if they're right, then we will use more supply. Next slide, please. Next. So where are natural gas prices going in the United States? Well, no one knows. I'm showing a couple of scenarios here. The only thing to remember is that there is considerable uncertainty in price forecasts for two reasons. First, we can't predict the weather, and the weather controls a lot of consumption. And number two, we don't know how many wells have been drilled for shale gas that have not yet been connected to gas sales. Next, please. The price floor, we could get down to $1 or $1.50 per million British thermal units by the end of the summer, depending on weather. Next, please. Credible forecasts suggest that gas prices by the end of 2012 will average somewhere between $2.30 and $2.40 per million British thermal units. Next. For 2013, the estimates are between $3.45 and $4 per million BTUs. The table on the top is from Goldman Sachs. The graph on the bottom is from Aperio Energy Research, my friend Mike Bodell, that I think does the best job of price forecasting. Next. So what are the conclusions? The conclusions are that shale gas has compensated for the decline in conventional gas production in the United States thus far. Next, please. Most analysts predict that the future will be much like the present. That's why we know they're wrong, because that never happens. They predict that natural gas will be abundant and cheap for decades. That doesn't seem probable based on our observations. Next, please. We see demand increasing and production is beginning to decrease. So that says that abundance is going down and price will go up. Next, please. The government is now fully engaged in the natural gas enthusiasm. Regulation and legislation will effectively mandate increased gas demand in the future. That's our belief. Next, please. Price matters, and many companies that were engaged in shale gas drilling are now in big trouble, serious financial trouble. Next, please. I would recommend that you beware of what you read and hear about shale gas changing the world, rocking the world, whatever. It is an important and a permanent change in our energy landscape. But the idea that it will be cheap and abundant forever, I think, is a false idea. I think that the change in supply and price may occur faster than most of the mainstream now forecasts. Next, please. We will skip that slide. I'm sorry. This is from a different presentation. This is, and so my final slide says, this magical thinking that we seem to have when it comes to shale gas. I go back to looking at Alice in Wonderland, and when Alice made the decision to pass through the looking glass, which is essentially the decision to say that shale gas will rock the world, then when she sees Tweedledum and Tweedledee, they look perfectly normal to her. So once you pass through the magical thinking of shale gas, strange things look normal. And I'll leave you with the quote from Michael Shermer, who's one of the writers for Scientific American. Beliefs come first, explanations for beliefs follow. Final slide, and thank you very much for your attention.